Hey guys, how's it going? So as you can tell from the title of this video, I'm going to be going over why right now I think that we're about to enter a bear market, as well as what you can do to protect yourself during this bear market. Now, if you remembered in my last video, I told you why now is a good time to buy silver and gold if you could afford it, because the S&P 500 actually just is about to cross this moving average, and as the S&P 500 goes down and the stock market goes down, you're going to see some gains in silver and gold. Now, if we look over here, we can see some bearish indicators. We can look at the candlestick indicator, which shows a dark cloud cover. It's not letting me. Okay, yeah, but that says dark cloud cover. We can look at the MACD line, which just crossed over its moving average, which shows some bearish momentum. And we can also look at the fact that the S&P 500 just broke trend and is also showing some bearish momentum there. Now, what can you do to protect yourself against this bear market? You can actually do a bunch of things. I'll just list them all off. You can buy inverse ETFs. You can buy put options. You can basically short the stock market, and you can invest in commodities that are going to go up over time and during recessions, especially like gold and silver, like precious metals basically. Now, I'm only going to focus on two of those in this video because basically shorting the stock market and buying put options, that's more for advanced investors, and if you know how to do that already and you're making a lot of money on that, there's no point in even watching this video really, because you know that we're seeing a lot of bearish momentum in the stock market and you're probably buying a bunch of put options and shorting the market already. But this is for you guys who are a bit new to investing and want to make some money during this bear market and not lose a lot of money. And what you can do is you can buy inverse ETFs, and you can buy basically commodities that are going to go up over time. So for example, gold. Look at that. Gold's up 1.13% today. And if we look at my prediction of silver going up recently, it's also up. Basically, it's following the exact same chart as gold. So look at this silver chart here, and now look at this gold chart, almost the exact same chart. And now I wouldn't buy into this right away. I'd watch it for a couple more days. I'd watch the S&P 500 for a couple more days, make sure this bearish momentum isn't just basically a retracement and that it's actually a bear market. And after that, I definitely buy some gold. I'd definitely buy some silver. And then, yeah, just hold it through the entire bear market, which could last anywhere from a few months to even a couple years if it's really bad. Now, the other thing you can do is you can buy inverse ETFs. Now, what is an inverse ETF? Firstly, we have to answer the question, what is an ETF? So an ETF is basically, it's an exchange traded fund, and what that means is basically it tracks an entire sector of the market. So let's say you have a utilities ETF, and basically if the utility sector goes up, your ETF is going to go up. Now, what an inverse ETF is, it's basically the same as an ETF, except it tracks the opposite direction of momentum and movement in the market. So if you have an inverse ETF here, as I do here, of the S&P 500, it's the Beta Pro S&P 500 inverse ETF, it's going to track the inverse of the S&P 500. So if the S&P 500 were to go up, then this ETF would go down. If the inverse ETF were to go up, then the S&P 500 would be going down, and vice versa. Right? So now let's just change this to the 15-minute chart just for better comparison. Now we can see over the past few days here, since like March 6th, basically, S&P 500 has been going down a lot. And if we look over here, we can see that this inverse ETF has been going up a lot. And basically that just shows that as the S&P 500 goes down, this ETF HSD, it goes up, the Beta Pro ETF for the S&P 500. Now this is also a leveraged ETF, and basically what that means is, let's say if the S&P 500 went down 1%, this would go up 2%. So yeah, it tracks 2 times the inverse of the S&P 500. Now, inverse ETFs or leverage ETFs, are riskier than just regular ETFs, and you can get a regular ETF for the S&P 500, but I trade HSD instead of that regular ETF. One, because it has a lot more volume, and number two, because, well, you can make a lot more money as well. The only risk with leverage ETFs is you want to be really spot on with the direction. You don't want to be sitting through a lot of choppiness, like choppy territory, because if you are, you can actually lose a lot of money instead of making anywhere near the amount you were thinking of making. And the reason for that is because there's a lot of rebalancing with inverse or leveraged ETFs. Basically, how they achieve this leverage, or how they achieve this 2 times leverage, is they have to buy options contracts and futures contracts and basically bet against the stock market. And those options and futures contracts expire, and when they expire, they have to repurchase them, and that basically cuts into the profits here. So even if you had perfect trend, let's say this S&P 500 chart, it went exactly down. You didn't see any of these green bars here. It went 100% down, 20%. You wouldn't see a gain of 40% in your HSD. You wouldn't see a gain in 40%. You see a gain in maybe about 35 to maybe 37%, maybe even less than that. And that's because of the rebalancing and everything. And that's if everything is perfect. That's if the S&P 500 goes down the whole time. It doesn't have any bullish reversals. It doesn't have anything like that. It goes down 100% of the time, which isn't ever the case in the stock market. There's always ups and downs, even during downward momentums. Even here, you can see, even though the S&P 500 has definitely been losing traction the past few days, you have seen some bullish reversals here, which is indicated in your inverse ETF basically by the same retracements. And you can see that these retracements are actually a lot larger than the bullish retracements here, and that's because of the rebalancing, and that's also because that it's of the fact that it's a leveraged ETF. So basically, yeah, you want to be careful. You want to only hold on to your leveraged ETFs for a short amount of time, probably maximum 2 to 4 weeks. You don't want to be going over that 1 month mark, because you definitely can be seeing some loss of your gains if you're going over that 1 month mark, and you definitely don't want to be holding on to your leveraged ETF during choppy territory. But yeah, guys, so those are the 2 ways that you can definitely make money during this bearish market here. You can invest in inverse ETFs, so you don't even have to buy the leveraged 2 times inverse ETF like I do. You can buy just a regular inverse ETF. You don't have like 1 times leverage, which doesn't do any rebalancing or anything, because it's a 1-to-1 ratio. And you can also invest in commodities like gold and like silver. So yeah, definitely watch the stock market these next few days. Watch it the next few weeks. Make sure that the trend is downwards. I definitely believe that we're going to see some downward momentum. I'm definitely investing in HSD today. So yeah, make sure you make some money during this bear market. Anyways, guys, thanks so much for watching. I really hope you learned something in this video. If you did, leave a like below, and please subscribe if you find any of this information useful. Thanks so much, guys. I'll see you in the next video.